I do want to hear from one of America's top financial advisors, Rich Saperstein. We're lucky to have you back, especially on a week like this, where we have volatility in rates, we have volatility in stocks, but we have a significant move from last Friday to Friday, as we're showing in the 10-year. What's on your mind? What are you telling clients?
Well, the stock market's been up 90% in the last 3 years, and in my 40 years, that's just incredible. Last year, we had the fourth lowest volatility in 25 years with only a 5% drawdown. PEs are elevated, both forward and trailing. We have a Fed funds rate, a real Fed funds rate that's minus 4.5%. Haven't seen that since 1975. So there's a lot of excess in all areas, both in the bond and the equity complex. And now you have a Fed that's going to start removing the punch bowl. So what's going to happen here? Well, basically, we have to expect a lot of volatility, okay, both in terms of the equity markets and the fixed income markets. But against that, we have very strong earnings growth. We have very strong consumers, low debt, high cash flow, record amounts of money in money market funds. And basically, we're going to see a continued demand for equities going forward. Now, the impact on the tech sector seems to be a big discussion. So we have to separate between zero earning tech and tech stocks that are generating enormous amounts of cash flow. The fact that the 10-year is going up 50, 100 basis points is not going to impact, let's say, the large cap tech stocks that are reinvesting $130 billion a year in CapEx. It's the zero coupon, the zero earning tech stocks that are going to be hit most. In fact, 40% of the NASDAQ is down 50%.
That's right. That's right. But let me just stop you then. Why, week to date, are names like Microsoft off 7.5%, Amazon 2.5%, Apple 3.5%, Alphabet 6%, right? I mean, these things have expanded their own multiples as the whole NASDAQ has ridden the wave of what we've seen from the other part of technology as well. And the fact that they've been defensive stocks, right? So if you've pulled money out of the high multiple tech, you've put it in to mega cap tech because you've said, well, those are the growth at a reasonable price stocks, and it gives me a little bit of defense as well to play in a more volatile technology environment. Rich?
Well, I wasn't doing backflips when they were up dramatically over the last 3, 4, 5, and I've owned them over a decade. So if you look at Microsoft, compound annual growth rate has been 30% a year. We're talking about $80 billion in operating cash flow, roughly $20 billion in CapEx. So there's $60 billion in free cash flow. The fact that the stock went down 6 or 7 or 8% this week, it doesn't move me at all. In fact, I'm compelled to add more on these pullbacks because I'm a long-term holder. I think investors should think about a portion of their portfolio. Where can you get earnings growth greater than the market, margins greater than the market, and enormous amounts of free cash flow that I don't believe is going to be impacted with the 10-year going up 50 basis points?